There are only 2 times per year where I start to buy and sell stocks in my portfolio. Today was that day. So, what did I buy? What did I sell? And why did I do it? Let's go ahead and break it down. So, here's everything that I bought and sold, and I'm going to give you a little bit of a description as to why. Let's first start off with NRG. I've talked about this stock before. The stock has done quite well, and all I did was buy more of NRG. It is up 52% in the last 6 months and up 110% over last year at the time that we are doing this video. Billionaires have also been buying a lot of energy stocks. If you want me to do a deep dive on what is going on in that sector and why they are snapping up shares of companies like NRG, just let me know in the comments, because I am interested in that topic as well. But I just added more shares there. I want to do more covered calls with this particular company, so I need to buy more shares myself. So that's all I did there. Caterpillar, though, I let go of. Okay, let go of Caterpillar, but not for the reasons that you think. Caterpillar is fine. It's actually up 13% in the last 6 months, up 36% over last year. I only made about 11%. Only. 11% is fine. It's definitely good in a normal year. I replaced Caterpillar with KKR. KKR is an asset manager. Think of it sort of like a Goldman Sachs, depending on who you ask. So Caterpillar gone, KKR is in. KKR is a company I've had on my watch list, I feel like, for like 2 or 3 years now. Just finally pulled the trigger there. They're up 28% in the last 6 months and up 90% over the last year. Really should have done this a long time ago, but had to finally make that move. I just feel like I could have done a bit better there. Though Caterpillar does pay a solid dividend, I do want to keep in mind this is all in the public portfolio, so everybody can see all these moves and see what I own. But I always want to try and be a little diversified because I already own a bunch of tech stocks already. Okay, so I can always just get more tech, right? But I want to try and stay diversified. So I wanted to do something, in energy, wanted to do something in finance, and kind of be off the beaten path while also still owning Apple and Alphabet and all those companies. Next here is DEC. DEC is its ticker symbol, but Decker Outdoors. We talked about this company. Told y'all about it last week. Okay, I broadcast this one, but it is up 45% in the last 6 months and up 84% over last year. I replaced it, or I picked this one up and kicked out Ulta. Ulta did not do well for me. It did not work. Ulta did not work, and I'm a little mad at it. So Ulta was down 21% over the last 6 months and down 18% over last year. 2 things wrong with Ulta for me. Okay, really 3 things when I think about it. Number 1, wrong with Ulta. It was up for a little bit. I should have sold it when I was up. I got a little greedy. I need to check the data to see exactly how long I had it. I feel like I've had it for 1.5 years now. But I bought Ulta. Ulta had earnings shortly after. It tanked. It started to come up. I should have sold it like right at that 6-month mark. I didn't. I told myself, hey, it's a value company. The numbers were good, and they were. I just continued holding it, thinking it was going to, be positive, and I was going to take whatever gain that I was going to get. That gain never came. So, should have sold it the minute I could have. I did not. I was a little too patient. The stock never really recovered. That's number 1. Number 2, I just think, again, this goes back to process. Just yesterday, we talked about the 3 most important things when it comes to investing. Last week, we talked about the importance, like the 2 or 3 tiny habits tiny habits you need to know when it comes to investing. And I talked about going back and reviewing your notes when it comes to investing and trading. The notes here tell me, okay, after just reviewing my notes and reviewing, I am not great at value investing. Okay, I read the book. Y'all saw me read the book. Okay, took notes, read the book, went back, read the chapters. I've done all the homework. I'm just not great at it. And the interesting thing is, when I go back and I'm staring at my notes here, right, and I look at, and I still have the spreadsheet on what I did when I looked at Ulta and what the homework was for Ulta and all the stuff I notated and all that kind of stuff. And we were right quote unquote. But it just didn't work. And not every time I do it, but most of the times I follow the value investing things in that book. What I follow just doesn't work for me. And when I follow my own process, my miss is Caterpillar. So I missed with Caterpillar and made 11%. That was my miss. And I miss with this and lose 20 something percent. So that's not to say that I'm better than Warren Buffett or anything like that. It's not. It's just to say I should be me and try not to be somebody else. Is what that really means. Because I miss with Intel. Okay, so that's not to say that I don't miss, because I do. But going back to that consistency piece, if I miss, I want to miss the way I want to, which is going to be that 11% more often than not. So this didn't work for me. That's not the only time that I've tried value investing with this exact same process, and this tends to be the result with Ulta and Ulta-like companies. So didn't work for me. Next here is Transdigm TDG. I picked up this one. It is up 28% in the last 6 months, up 50% over last year. I am replacing it, which means I am selling Marriott. Marriott is up 7% over the last 6 months and up 31% over last year. Marriott is fine. Nothing wrong with Marriott. We did talk about Marriott. Said Hilton was better from a stock perspective. But I just think I want to make a little more. Okay, don't want to be greedy, but I want to make a little more. So selling one, picking up the other. So we're just doing a flip-flop here in this particular case. Next here, I'm selling Palo Alto Networks. Just selling, getting rid of it altogether. Is up 14% in the last 6 months, up 32% over the last year. I think Palo Alto Networks is fine. I do think it is slowing down a bit. Not saying it's falling off, but I am taking my profits and I'm going somewhere else. There's two reasons why I'm doing this. Number one, because it is slowing down. Again, I'm not saying it's falling off the map. I'm not saying it's crashing. Okay, I'm not saying that. But similar to like what was it, Hershey's that we talked about not too long ago. Like, it was great then. Took our gains, gone somewhere else. I'm kind of doing that now, where only up 14%. I say that in air quotes because it is still pretty good, but I'm going and taking my gains and going somewhere else. The other reason why too is because as I'm buying and selling and doing all the stuff in my public portfolio, I don't want to have 18 or 19 stocks. Okay, I want to keep it between like 10 to 12, because it's I have to research all these companies, know what's going on with all these companies, and having 15, 20, that's too many. Right? I want to keep it relatively small, keep it manageable, and know exactly what is going on. So I want to trim things down. I have too many, right? So selling that all together, taking that money and just redistributing it, selling it, and then just investing in everything else and just pushing those dollars upward is going to be helpful. Also, having more money in those other companies that are doing well is going to help the entire portfolio across the board. So that is the thought process there. Two other smaller moves. This is in my daughter's portfolio. Everybody else in the family kept all their stocks. Everybody else was fine. She had Lululemon. We had talked about Lululemon in the previous video this week. Down 41% in the last 6 months, down 20% last year. She, was born in the pandemic. Stock was doing well. We got rid of it, gave her Chipotle instead. Y'all know how I feel about Chipotle. I own Chipotle. Chipotle is up 37% in the last 6 months, up 46% over last year. We talked about them doing their stock split and how good that could be for the company and how well the company was doing. And then Netflix. She had Ulta as well. So we're taking out Ulta for her, or did take out Ulta for her, and picked up Netflix. Again, Netflix up 38% in the last 6 months, up 53% over the last year. Now, when it comes to Chipotle, again, they were one of the few companies, one of the many companies that did a stock split here pretty recently, including Walmart. Now, I was one of the few people, they weren't the only people, call it what you want, but one of the few people that did predict that they were going to do a stock split. And in that original video, that wasn't the only company that I said, hey, they might do a stock split, and actually did it. Lam Research Corp was another company that I said in that video that happened to do a stock split as well. So I did a follow-up video about some additional companies that could announce a stock split here pretty soon. If you want to know what companies might be next in terms of stock splits, you want to check out this video right here.